Home sellers and real estate agents. Did you list a home for sale and instead of a line down the street and offers pouring in by the dozens, all you've got is a big bowl of crickets? Don't worry. In this video, I'm going to explain to you exactly why you don't have interested buyers and offers coming in. And more importantly, I'm going to show you a strategy that's going to help you attract them and get somebody to buy that house. Stay tuned. All right, Matt the Mortgage Guy, residential mortgage broker, licensed in almost all 50 states. Contact me and my team. Go to greatmortgagebroker.com. Get expert advice firsthand from me and my team. So on to the video. I really want to thank Jorge G. Realty on YouTube for inspiring this video through conversations on my live stream talking about this information that's really vital for both real estate agents and sellers to know in today's market, Q4 of 2022, probably Q1 of 2023, and maybe even beyond, why we have demand off of a cliff. You don't have people lining up to see your house, put offers in on your house. I'm going to show you the math behind it, because the short answer is the reason why you don't have nearly as much buyer demand and you can't sell for the same price your neighbor did or as fast as your neighbor did in this market is really just to do with math. So I'm going to put up on the screen $500,000 purchase. If your neighbor sold for this number and somebody got a loan 6-8 months ago at 3.25%, taxes, insurance, principal, interest, all in mortgage payment, if this buyer put 10% down, would be $2,637 a month. I use 10% down. The average first-time buyer puts 7%. That's based on statistics. I know some people put 20, some people put 30, others put 3, others put 5%. Let's use 10% as an average buyer. It's going to come through and buy your house for $500,000. So if they did this, let's call it March, and had a 3.25 30-year fixed, their total payment is $2,637. With interest rates near 7%, on a 30-year fixed loan, that same $500,000 purchase, all-in payment, mortgage insurance, taxes, insurance, homeowners, everything, $3,673 a month, over $1,000 more per month. As you would expect, less people are willing to pay $3,600 plus some than $2,600 a month, right? It's $1,000 difference in payment. So I'm going to give you the answer, but first, what I'm going to tell you is the good news is you don't have to concede a huge number on the price to make it more affordable for the client. If I wanted to do the math to see what price I would have to come down to with that 7% interest rate to make the payment similar, we'd come all the way down to $360,000, $2,644 a month, right? Same payment, $140,000 off the list price, nearly 30% off the list price. That, my friends, fortunately, is not something you're going to have to do. So if you're a seller and you're trying to meet in the middle, have a product that is doable for a client that fits in their budget, you're going to do one of two things. You are going to lower the price and or offer concessions so that the buyer can improve their mortgage. Concessions just means credit. You're giving the buyer $5,000, $10,000, $15,000 in credit from your net proceeds to say, hey, this is going to help you buy down your mortgage interest rate. This is going to help you do a 2-1 rate buy down. I'll explain that in detail as well. You might do a combination of the two, lower the price and offer the concessions. So let's run through some quick math. And let's say that a buyer in this market, right, is looking at your house, and you might not be able to get $500,000, but you're trying to meet somewhere in the middle. They can't do $3,600 a month. They're saying, you know what, I really need to keep my payment between $3,000 and $3,200 to make it fit in my budget. I know interest rates have gone up. I know it's not March anymore with 3.25, but I want to make this work. I like this house. how can we get the payment between $3,000 and $3,200? Let's do some quick math. You could offer some concessions to buy down their interest rate. If the concessions were just to buy down the interest rate to a 5.99%, and you also said, you know what, I'm not in the same market, I would take 480 plus the, let's call it 10,000 in seller concessions to buy down the rate. Now you've got a payment of $32.41 a month. This might be doable for a client, right? It's $400 less than that 7% and $500,000 purchase. So as a seller, you basically conceded about 30,000, 20,000 in price and 10,000 on the rate buy down. In some cases, you might still be able to get the 500,000, and maybe you've got 15,000 in concessions that gets the buyer down to a 5.75%. $33.05 a month. Maybe that works. And now you're only conceding $15,000, right? What we're trying to do is make the buyer have a comfortable mortgage payment that fits in their budget. Sometimes it's a qualifying issue, and they might not qualify above a $3,300 a month payment. Let's take a look at something else, which I think is a really good tool to use in this market. It's called the 2-1 buy down. Now, as the seller, this is coming from you as a seller subsidy. You're offering a credit. In the same example, for a $500,000 purchase with 10% down, you can offer $10,241 in seller subsidy, which is going to allow the buyer, they can either, with that $10,000 credit, the buyer could, apply it towards closing costs or something else. Most buyers want to apply it to the 2-1 buy down or something similar to help them with some payment relief. In the case of this buy down, in the scenario that I've got a client right now locked into, this buyer is going to have a 4.5% interest rate in year 1, a 5.5% in year 2, and then 6.5% in years 3 through 30. What this does is it saves the buyer quite a bit on the monthly payment. Even at the $500,000 purchase price, $2,933 a month. Gets their payment under $3,000 for that first year. Second year, it's $3,208, and then years 3 through 30, it's $3,497. In this case, the buyer is saving $10,241 in payments over those first 2 years. You're subsidizing that lower interest rate, 2% lower in year 1, 1% in year 2. But again, that's a $10,000 seller subsidy versus having to lower the cost of the house by $50,000 to give them the payment they're comfortable with. So between these two things, lowering the price or giving a seller credit, quote, seller subsidy for a 2-1 buy down, or a seller credit that allows the buyer to buy down the interest rate permanently and just go into a 30-year fixed at say 5.99 or 5.75. These are things that collectively buy side agent, list side agent, buyer, seller, loan officer working together on this issue, which is affordability, right? Because buyers are not lined up down the street to get into a $3,600 a month payment. We've got to get creative. We've got to work together, and we've got to help make sure that a buyer is getting into a mortgage and a mortgage payment that they're comfortable with. Hopefully this was helpful. Hopefully this helped. Every agent I talk to, every agent that I partner with knows that now more than ever, we are working together with the buyer to figure out creative ways. And by creative, what type of seller credit do we need? How do we structure an offer between price and between credits to buy down the rate, either, for the first 2 years or permanently buy down the rate? There's all kinds of options. If you're working with a great lender that knows how to structure these things, you're in good hands. If you want to connect with me and my team, greatmortgagebroker.com. Thanks for watching. Hopefully this helped. Have a good one.